accountant to understand finance, but you do have to know just a couple of important things about accounting. First, financial statements follow the same general format from one company to another. Individual line items may vary somewhat depending on the nature of the business, but the statements are usually similar enough that you can easily compare performance. The reason for the similarity is that accountants all follow the same set of rules. In the United States, those rules are called Generally Accepted Accounting Principles, or GAAP, pronounced GAAP. Second, GAAP allows two different methods of accounting. Cash-based accounting is typically used by very small companies. It's really simple. The company records a sale whenever it receives cash for a product or a service and records an expense whenever it issues a check. The other method, accrual accounting, is a little more complicated and far more common. The company records a sale whenever it delivers a product or a service, not when cash changes hands. That might be a month or two later when the customer pays the bill. It records an expense whenever it incurs one, not when it actually writes a check. The key to this method is what accountants call the matching principle. Match every cost to the revenue that is associated with it. Let's look at an example. Amalgamated Hat Rack, an imaginary company that manufactures hat racks from imitation moose antlers, records revenue each time it ships racks to a customer. Because the customer hasn't paid yet, revenue always includes estimates of cash the company will receive in the future. When Amalgamated orders 2,000 brass hooks from a supplier, it doesn't record the expense of those hooks all at once. Rather, it records part of the expense with every sale. If each hat rack has 5 brass hooks, the accountants record the cost of 5 brass hooks every time one hat rack is sold. Why use the accrual method? Because it gives you a more accurate picture of profit. If you work for a hat rack company, you want to know whether each hat rack you sell is profitable. To answer that question, you have to track the cost you incur and the revenue you bring in every time you make one and ship it to a customer. The income statement. The income statement tells you whether the company is making a profit, that is, whether it has positive net income, according to the rules of accrual accounting. Income is just another word for profit, which is why the income statement is also called a profit and loss statement, or P&L. It shows a company's revenue, expenses, and profit or loss for a specific period of time, typically a month, a quarter, or a year. How does an income statement present this profit picture? It begins with the company's revenue, or total net sales, same thing, during the period it covers. It then lists all the various costs, including the cost of making the goods or delivering the services, overhead expenses, taxes, and so on, and subtracts them from revenue. The bottom line, what's left over, is the net income, or profit. See Figure 1, Amalgamated Hat Rack Income Statement. Let's look more closely at the line items that appear on the income statement. Cost of goods sold, usually abbreviated as COGS, is what it cost Amalgamated to manufacture the hat racks. That includes raw materials, labor, and any other costs directly related to production. Subtract COGS from revenue and you get gross profit, which shows how much the company made before paying its overhead, taxes, and so on. You can use this number to calculate gross margin, which doesn't appear on the income statement but is still an important number. Just divide gross profit by revenue. Amalgamated Hat Rack's gross margin is $1.6 million divided by $3.2 million, or 50%. Operating expenses, also known as